Welcome back, everybody, to episode 6 of the Listen, Loan, Let's Go podcast. Xavier, welcome back.
Thank you.
Are you excited to be back here today?
Yeah, always excited. Let's share this knowledge. It's bursting out of me.
Absolutely.
We need it out.
I could see that as we're writing some notes prior to recording today. You're very excited to get into a few topical newsworthy events for this episode too, which is really exciting. So what are we going to cover on this episode?
Well, we're going to cover a bit of news and a few tips and tricks for our borrowers out there. There's a lot of uncertainty, a lot of noise, as always.
Yes.
So how do we cut through that and let people sleep at night, I suppose?
Absolutely.
Let's try and help with that.
Well, let's do it because we're hearing a lot in the news. I've got a few questions for you that I just keep hearing these terms that I don't understand, and I'm sure a lot of the listeners don't understand either. So you're going to help debunk that. So should we get stuck in?
Yeah, go for it.
Let's do it. Okay, Xavier, here we go. The rental market. We're hearing about a crisis. What does it mean? Talk to us about it.
Yeah, there's a real crisis in the rental market. There's just not enough dwellings to house everybody. Now, whether this was renting or buying, same issue. It's great for investors, but it's dire straits for renters. And I actually picked up some articles here. It talks about Queensland rental crisis persists. We're seeing more and more people trying to get out of the rental treadmill, I suppose, but in unconventional ways. So we're hearing more and more kids who are going to buy property with their parents and live together because prices have gone up as well. So parents can't always afford a better, bigger, more expensive house, but with the kids they can. So it's a trend we've started seeing probably in the last 2 or 3 months.
Okay.
You see 1, 2, and then you start seeing a fair few. You think, well, where's this coming from? And these are the sort of things. There's even another article here, and this is interesting. We don't have time to dig into it, but it says, government scheme to turn vacant properties into long-term rental. The $5 million scheme offers payment to owners who leave vacant properties, who lease vacant properties for at least 12 months. So basically, if you've got property it's empty, not only you can collect rent if you put a tenant, but the government will also give you a subsidy to please put it on the market because we need more properties. Obviously, the red tape in government hasn't been fixed and they can't cope, but we do have a real crisis out there, especially in southeast Queensland where we are, but generally I think nationally in the country.
Yeah. Historically, in your time and being in the industry, have you seen it this bad? Has it been worse?
It's been a long, long time.
Yeah.
The rental vacancy is 0 point something.
Yep.
And we hear a lot that, rental property was there, 20 or 30 people went, and obviously only one can get it.
Yes.
Where'd the other 20 other people go is the question. So they're trying to buy, but that pushes more buyers on the market. So we have the same issue on that side of the fence.
So what do you think of hearing the news like that and that kind of scheme? How do you feel about that personally?
So the multiple person in me as an investor, it's great.
Yes.
And so that's good. It's a bit of a shame to have a situation where we've got tons of immigration, tons of people coming in, but we haven't thought about what we do with them. There are some government schemes for first-time buyers that help a lot, and we use a ton of those as well.
Yep.
I think we just need more properties to be released on the market for people to buy.
Yeah, it's certainly a very complex issue. But then we also turn our attention to interest rates and what the government is saying. I'm hearing everywhere that's just increasing. What does that mean? Can you dissect that for me?
Yeah, so that's been interesting in the last few months or since the beginning of this year. We went from inflation and threat of increased rates to now we're kind of okay, we're going to drop them soon. I think we covered that in one of the last podcasts.
Yeah, you love inflation.
Yeah, and interest rates too. So we did a bit of newsworthy a few months ago about how the rates were going to drop. We weren't sure when, but sometime this year. And since then, you're right, the news has been that, hey, wait a minute. And I think Michelle Bullock from the RBS said, hey, maybe we're not done yet. I'm like, are you? Maybe we're not. And usually what happens is when they're trying to fix something and it's nearly fixed but not quite, everyone seems to be a bit too soon.
Okay.
Right? And so that pushes the government to go, whoa, wait a minute, don't spend your money just yet. We might still increase it. So I think it's a scare tactic.
Okay.
Actually, with that, another article I've got here. So economists remain firm on rate cuts this year. So all the lender economists continue to anticipate rate cuts later this year, despite the central bank entertaining the potential of discussing rates. Now, entertaining the potential of discussing, there's nothing straight about that. Scare tactics, I think.
Yeah, that's really, really fascinating. And then again, also in the news, broker market share keeps increasing. I don't even know what broker market share means. So what does that mean to the average Joe like myself?
So if I ask 10 people, you included.
And DOS.
That's it. So are we going to the bank or are we going to broker when we want a loan?
We're going to the broker.
Right. Yeah. So 7 or 8 people out of 10 are doing that now. 10 years ago, it was only 3 or 4.
Okay.
So the broker market share, we're at 70, 80% of home loans are being written by brokers, right? And that is steadily increasing. It's been increasing a lot. And you think, well, why? I mean, the banks are still the one giving the loan. Why are people not going straight there? So there's a few reasons. We've covered some choice and expertise, but then also, here's another nugget I've been collecting.
You certainly have been.
75% of people think banks are prioritizing profits over service. The majority of Australians believe that banks are putting profits over customer service. And I've got to say, by periods or depending on which lender, we can see that. We're talking with one of the majors not that long ago in this space actually about how they should start giving better rates now that the reporting season's over for the ASX. So obviously shareholders more important than borrowers there.
Yeah.
But it happens a lot. Banks go back to their bad habit to try and increase profit by increasing margins on home loans. And obviously for us as brokers, we want the opposite. So the reason broker market share increases is because we've got borrowers back more than the banks have.
Well, I was going to ask, do you see there's less trust now? There tends to be a bit less trust now in the government by the average, punter on the street. Is it the same with banks? Are people less trustworthy of what the banks are saying and even communicating with banks?
I don't know if anyone ever trusted a bank.
Yeah.
I don't think it's improving.
Yeah.
And unfortunately, the banks are getting the squeeze. They're realizing that, opening a branch to write home loans is not that profitable. There's probably only a couple of banks left who are trying to hold on to that, but all the others, they're shutting branches. They get it. Like, it's more expensive that way, and people don't want to go into a branch to get a home loan. They don't know which label or which brand they're going to choose, whether it was for rates or just to get a yes from. Because as I say to all my borrowers, it doesn't matter what the rate is or what the label is. If they're going to say no, then they're not yours anyway. So if you're a punter on the street needing home loan, which bank do you walk into?
Yeah.
Confidently, if you want to walk out with an approval. You don't know, right? So that's things we know as brokers. We analyze your situation, we come up with recommendations, and ones that, recommendation A or B, they pay me the same.
Yes.
Right? Which one's better for you becomes our main focus. The bank's only got one to offer, and the more they give you, the less they keep. So there is an issue there.
Well, I was just going to ask, what are a couple of the main differences between going to the bank versus the broker?
Okay, so we're doing it backwards, or is it the bank doing it backwards for the customer anyway? So when a customer goes to a broker, the broker looks at their situation, try and understand their goal, and then basically does a matchmaking exercise. Which loan, which bank will suit you better, will be more beneficial for you, and they'll work out, right? When a customer goes into a bank, the bank only has one type of product, so it either fits or it doesn't. And then the price of that product is what we talk about. The more the bank gives to the punter, the less they keep.
Yep.
So there's a push and pull here.
Sure.
Where, for me as a broker, I want you to have the best deal possible so you come back to me.
Yes.
It makes no difference to my income. If you get a 2% rate or a 10% rate, I get paid the same. I want you to have the 2% so you can be a raving fan to all your friends and they will come and see me as well, right? So that's the big difference between bank and broker.
Well, it segues perfectly into the sort of the next part that we want to talk about, which is a bit more about you personally and what your goal is as a broker. I know it's a very open-ended question.
Yeah, wow.
Okay. It's quite difficult, quite deep.
Lay that on me like this. Fine. Well, my goal as a broker is to make sure that all my borrowers have got the best solution and are moving forward financially. So at Go Mortgage, our tagline is, let's build your future, let's go. We understand that property is super powerful and can make a massive difference in someone's life. So it's not just about a loan. It's not just about an interest rate. It's about how do we craft your financial life to fit your social life, but also advance you, you know. And we're talking about rental crisis. We're talking about how hard it is to get in the market. So it's also super special if you are in it, and very valuable. So we want to look after that position and increase it. Yeah.
And again, your priority is keeping customers safe. So talk to us a little bit about smart data, because this is something new. We're probably going to reference it over the next few episodes, but now's probably a good time to dive into it a little bit deeper. So what is smart data?
Okay, so let's start with data first. So we analyze your data to come up with an outcome. It's always been the bane of this industry process that we have to collect all that red tape, and everyone hates that stuff, right? So I get it, but if we don't do that right, then we can't assess it properly and we can't come up with the best solutions. So what we're trying to do is make that data collection as simple as possible, but also as thorough and as safe as possible. So when your data travels or your document travels over the internet, they're at risk of hacking. So we try and reduce that as much as possible. And also we try and get as much data as possible, which is kind of, well, the more you send, the more risky it is. But so we've come up with, we've used technology, and thanks to our systems and our aggregator, we're going to reduce the amount of time it takes you as a borrower to give us your data, and also in the same time make sure that the data is more correct and safer. Right, so we've adopted technology where instead of sending us your driver's license, you're going to take a photo and put it in our system straight up. So your driver's license doesn't travel. When it uploads, it's going to be checked against government data, right? So we make sure that this ID that's been uploaded is real, it's not a fake, and it's all your information. That automatically moves through before you had to key it in, no more keying it in. We do the same.
That's a big help, I can assure you.
Yeah, that's right. Same here. I've got fat fingers. And then we do the same with your credit report and your bank statements. So we analyze all that. Before, you had to tell us how much you spend in Netflix and breakfast and all that. And it's get tricky. Like, how much do we spend, right? But
please don't ask me. I'd hate to know. Yeah.
Right. So, but if we were able to get a computer to read your bank statement, and then categorize all that in like 0.1 of a second and say, hey, is this what you spend? You can go, yeah, sounds about right. Done, right? So we've counted that before it took about 27 minutes for you to prepare all the documents, upload all your information. We're going to reduce that from 27 minutes to about 7 minutes. So we're trying to save our customers time, but also make sure the data is of better quality.
Yeah.
Right? So we should get a better outcome in less amount of time.
That's awesome. I mean, because even just driving here today, we had to go get the car rental, and the amount of time spent on just filling out all this useless, well, not useless, but information that is time consuming and annoying. And by the sounds of it, it's much more accurate, especially if they're scanning your bank, documents, and people probably feel better about that rather than you going through it with a, fine-tooth comb as well. Have you noticed anything yet?
Well, it's going to save us a massive amount of time. So 20 minutes is the amount of time that one of our customers or potential customers will spend, but we'll probably save, 4 or 5 hours in terms of, because we need to forensically analyze living expenses, which is, but this was a special month, I went on holiday or Christmas or something. So we need to try and think of all that. At least that's all going to be chewed. The credit report and the ID is also eliminating a lot of risk. So there has been instances of people having their house stolen, basically by identity theft. So we don't want to be a part of that. No. And this system enables us to make sure that every customer that comes to us is real and not impersonating anyone else. if that makes sense.
Love it. So you're going to hear smart data a lot, listeners and
Yes.
viewers. So when we reference that, that's what we're talking about. Now, in one of the previous episodes, we talked about, and you debunked these guys on TikTok or social media that say, I'm going to,
Yes.
write off your mortgage in 10 years. Now, we debunked some of that BS, but now you're going to actually help us with a little bit of advice. How are some ways we can actually move that process forward faster without these scammy online?
Yeah, so but basically the what we debunked is that, yes, you can pay your mortgage off fast if you don't pay it off, but you go buy another property, you can wait for it to go in value, sell, and then pay your mortgage off with. Now, that still works. Just be careful of spruikers out there. But what are other ways? You don't want to buy another property. How can you still make inroads into your mortgage?
Yes.
What are simple tips? Obviously, we hear a lot, well, how about you pay fortnightly instead of monthly or weekly even? That does work, but what it really does is it makes you pay more. So as simple maths, I know maths is not always easy, but there's 26 fortnights in a year, and there's only 12 months. Now, if I divided 26 by 2, it's 13. When you pay fortnightly, you effectively pay 13 months.
Right, that makes a lot of sense. Yeah,
So
never thought of it that way.
It's not magic, you're just paying more. So obviously if you're paying more, it goes faster. So if we segue on that, well, why don't you just decide to pay more rather than, I'll go fortnightly, the bank forces me to pay more, I think it's magic.
Yeah.
No, let's do a bit of budgeting. I know, it's annoying, right? But we can do it just once, and I would recommend for people to do that. So throw a few different buckets around, so we know what the bills are going to be, we know what the lifestyle is going to be, we know what the house is going to cost. So if you look at your budgeting in 2 or 3 separate areas, you can quickly get an idea of how much you spend, because it changes all the time, right?
Yes.
So once you know that, you know how much you've got left to pay the mortgage, right? Now, some people go, that's still too hard for me. Okay, I get it. So how about we do it the other way around? Let's forget about the budget. We know how much the bank told you to pay, $2,322 a month. Can you afford $2,500? Can you afford $3,000? Because if you can, why don't you just pay that?
Yes.
And you accelerate yourself in a simple way, right? Another way to merge these two in an easier way than writing down your budget is to use offset accounts or multiple offset accounts, right? So we do that with a lot of clients. You might say, well, what is an offset account to start with? Good question. An offset account is an account that's linked to your loan, and any money that's in the offset basically saves you money on the home loan. So if you've got $20,000 in your offset, the bank doesn't count interest on $20,000 of your home loan.
Okay.
Okay, if you've got $100,000 in your offset, then you don't pay interest on $100,000 on your home loan, right? So the more money you have in offset, the better. Now, what if you have multiple ones of these? So you had 3 or 4 of these, and now with banking and tech, it's cool. You can nickname stuff, right? So you can nickname an account bills, nickname an account kids, savings, mortgage, whatever you want. These become your little buckets I was talking about in budgeting before, right? So you might say that, hey, we need, I don't know, $500 a month for bills, $300 for entertainment, and we're going to keep the rest in the savings account, right? So you'd have your 3 accounts. When your income comes in, you just split them up. That's it. You're a master budgeter now. And then all you have to do is tweak it along the way. All the money that are sitting there are offsetting your home loan until the day the bill needs to get paid. So I hear all the time people say to me, oh, yeah, but you know the rates. I pay them weekly. I'm like, I don't know any council that issues weekly rate bill. It's quarterly or half yearly, depending, way in Australia. And they said, no, I pay it weekly, so I know when the bill comes already paid.
Gotcha.
But I'm thinking the money is with the council. The money should be in your bank account until the bill needs to be paid. And people say to me, yeah, but I'm scared I'm going to spend it. And when the bill comes, I don't have it. This is where budgeting comes in. If you put that same money weekly in your offset, when the bill comes, you've got all the money there, you can pay it. In the meantime, it sits against your home loan, reducing your interest. So a multiple offset system is a great system to use to do that without being a nerdy budgeter. That I know it's not real. People don't really do it that way. Oh, very few people do it that way.
Well, here I was thinking your offset accounts is this dodgy account in the Bahamas that the government don't know about, but you've debunked that. Well, we've covered a lot so far in this first segment, so thank you so much for going through a bunch of that. Let's head into the next segment now, where we're going to have a look at some more news. So we talked earlier about some hot topics and some trendy words that we're hearing a lot online and in the industry. What about rent vesting, Xavier? Because that's a concept that we actually knew about, but not until you explained it to us that we actually could identify that that's what it's called. So what does rent vesting mean?
Yeah, so and that ties in. So I mentioned before that we're seeing changes in buyer behavior due to the scarcity of property and the prices increase, even the rental increase. So what rent vesting is about is it can be in two situations. So the first one that ties into that was, well, I can't afford to buy a property to live in, but if I stay at mum and dad, then maybe I can afford an investment property, and that'll get me in the market. So and especially if you're at mum and dad's without having to pay board or rent, then it makes it easier to save, but it certainly increases your borrowing capacity. So if you don't have rent or board on your expense sheet when we take you to the bank, but you've got a property that's going to have rental income, then it's a double whammy in terms of how we can increase your borrowing capacity. And for a lot of young people, that enables them to get in the market. Yep. Right. There's also rent vesting is also for those who they can't afford to buy where they want to live, right? Because it's expensive. So you can then rent where you want to live and buy where you can afford, right? It also segues into those who don't know where they want to live. Well, they certainly don't want to get tied down to somewhere. So you might want to live in Melbourne this week and Sydney the next, or New York, I don't know. But you can buy a property where you can afford and at least be in the market so that you collect the capital growth, right? So it's a multi-prong. It helps servicing with the bank, but it's also a lifestyle choice.
So when did you start to see this trend kind of take off?
So rent vesting's been on and off always, right? Because, and I think we were talking, you said, well, I don't know where I want to live next year or the year after. Yeah. Well, that's perfect for you. That doesn't mean you shouldn't buy. It just means maybe you buy for someone else to live in yours and you go live in someone else's. So we do it this way. But it's not when it started, it's when it gets prominent, right? So the younger people are not sure where they want to live. That happens all the time. But those who can't afford to buy where they want to live, that's cyclical. And right now in this cycle, we're there, right? So inflation, cost of goods, interest rate, everything is stretching the budget. Well, when everything stretches the budget, it also lowers your borrowing capacity, right? If you couple that with prices that are increasing and increasing, so you've got lower borrowing capacity and higher prices, it doesn't match, right? So maybe you can't buy in the 2K radius or the 5K radius to the CBD, but you can buy in the 20K radius, but you don't want to live there. That's fine. Buy it, let someone else live in it, and you go live renting or boarding at mum and dad.
Yeah, it makes total sense.
The idea is, and we had in one of our previous episodes, the principal of Ray White, Ali Mian, who brought a brilliant quote. I really loved it. He said, when the tide rises, the small boats, the big boats, they all rise, right? So what you're doing in investing is you can't buy the big boat. You're going to buy a smaller boat. At least you're a boat owner. And that's the idea, right? And when the tide rises, you benefit as well. Even though you don't live in that property, it still rises with the tide. It depends that you're on another boat somewhere else. That's fine. It doesn't really matter.
Yeah. It makes total sense too. I mean, we covered it in a previous episode about when's the right time to buy, and everybody always says yesterday. So it's about getting your toes in the water, getting your foot in the door, and actually getting into the property market ASAP. Is that?
That's right. And we talk about that. So when's the right time to buy? Also look at the property market with this analogy, right? So imagine there's a track and there's a train on it and the train's moving. Right, there's people on the train. They're the property owners. You're running behind this train.
Yes. Yeah.
Right. So if you don't jump on, you're going to keep running. Right. So the idea is to jump on the train, and rent vesting enables you to jump on a smaller, slower train, but at least you're on the train now.
So just debunk a myth for me too, because my understanding was, I don't know how true it was though, if you once you buy your first property, or you have to live in that for a year. Is that true or not?
That's only if you buy it as your home. So
Okay.
you're allowed to buy as an investment property, and in most states you don't actually lose your first home buyer's incentive. So
Oh, really?
in Queensland, for instance, where we're at, if you buy a property and never live in it, it's pure investment. You don't lose your entitlements to your first home, but also you don't get first home buyer benefits on your investment, right?
Yes.
So it works two ways. You can say, hey, this is not my first home. I just want to buy an investment. I will pay the investment stamp duty and play the investment rules. You can do that, jump on that train, and then later buy your first home with first home buyer's incentives.
So what are some of those rules? Because again, how can you prove that it's an investment property, not a home, without ticking a box?
Yeah, so firstly, you pay investment stamp duty.
Okay.
So if you buy your own home, you get a concession on stamp duty in most states, but not for an investment.
Okay.
Then you don't live in it. Yeah,
Yep.
so that's pretty simple. You rent it out, and you declare that with the tax office. So you declare the rent and the expenses and all those sorts of things. So if you do it properly, that's all you really have to do.
Perfect. Well, that debunks that for me, because that was a misconception that I had too. So thank you again for another fantastic episode. We covered a lot
My
of
pleasure.
trending topics at the moment too. But as always, how do we get in contact with you?
Just Google it, Best Mortgage Broker Gold Coast.
That's all you have to do. Or you can click the link in the show notes or on the YouTube. But once again, Xavier, thank you so much, and look forward to chatting with you next month.
Yeah, same here. It's been great.